This is Investment Perspectives with Brad Kimes, daily live streaming interactive, featuring Mrs. Backup. Subscribe, hit the notification, smash the likes. Now, here's Backup Brad Kimes. Come on in.
Welcome back to Investment Perspectives, everybody. I'm Brad Kimes. You can follow me at Backup Bradley on Twitter. Today, we're going to talk about an article that came out from NASDAQ. Yeah. Unlimited money and no liquidity. Welcome to 2020. Well, that's not all we're going to talk about, because this article as well helps to continue a conversation we've been having here on this channel, which is stablecoins. Now, you know, we covered recently, just to kind of catch you up if you haven't caught what we've been talking about here. We've been talking about this article, central banks recommended to ban stablecoins 2 days ago. And this was the original material that was put out from Block Crypto. G20 Watchdog issues recommendations for regulating global stablecoins, and they released 10 high-level recommendations, which I'm not going to run through now. You guys can go and check it out on my Twitter, or you can read, and pause this and read it. But it leads basically to this conversation about central banks being recommended by that particular entity of the G20 to ban possibly stablecoins, private stablecoins. Now, coming back to this conversation here today, this is important because we're getting ready to tie together why that might happen. Okay, let's read this. It's not a terribly long read, so let's get into this. All right, watching the Fed's kitchen sink response to the financial fallout to the pandemic has been nothing short of extraordinary, beginning with above expectation standing repo operations and Fed bazooka, and now a $6 trillion stimulus package when accounting for the Fed's leverage of $4.25 trillion discretionary lending facility and $2 trillion government stimulus package. All of it happened within a span of several weeks, as if we needed more evidence of the global financial fragility to stoke the fire pits of the pandemic dilemma. The president of the Federal Reserve Bank of Minneapolis provided the cherry on top with this recent comment of infinite cash at the Federal Reserve. Okay, so welcome to the era of helicopter money 2020. The beginning of the crisis, we're going to go through this. This is not a long read, but it is going to be an important one, again, to tie this conversation together. Atrocious manufacturing reports from China and the U.S. aside, there's no consumer demand right now as people are quarantined in their homes, and the supply chain is already choked by the pandemic. Increasing numbers of people that are hospitalized, businesses are struggling, the dollar is screeching higher as demand for it soars, and market liquidity is non-existent. The short-term treasury yields are negative as investors flee to safe havens, and rumors that the Fed may enter junk bonds and equities seem less ridiculous than at any point in its history. What's evidence is the $6 trillion stimulus, including bailouts for major industries, corporations, at the discretion of the Treasury Department, might be the straw that broke the camel's back. Keep in mind that we've talked here on the channel also about the Fed Reserve going in and going through a bankruptcy. So keep in mind that as a backdrop, hearing that last line there, talking about, the discretion of the Treasury to take the Fed to bust, potentially. We are entering modern monetary theory territory. This is not capitalism, and that is for sure. It hasn't been for a long time. Remember, capitalism is two very important components. It's profit and loss. Financialization of the economy and strained global supply chains have left small businesses and the investors reeling as if current market scenario was plucked directly out of Mandelbrot's The Misbehavior of Markets. Volatility reigns and is occurring in concentrated clusters. Once again, the financial system has been duped by a period of artificial low interest rates and market tranquility. And the Fed's response to the crisis may be out of ammo. This is something we've talked about before. The stimulus, the quantitative easing, all the cutting interest rates, they're at zero now. The crisis has actually unfolded at everyone's doorstep. And now you combine that with a pandemic on top of it, because they are two separate events They are two separate events happening simultaneously. Okay, so interest rates are already at zero and cash reserve requirements for commercial banks were removed. Now it appears that the line between the Treasury Department and the Fed will fade away, opening up a new era where the fiscal response of the pandemic quandary may overshoot the dollar demand it's aiming to plug around the world. 6 trillion USD is a significant chunk of money. In fact, it's roughly 28% of the US GDP for 2019. GDP for 2020 is already projected to contract by 14% in Q2, according to JP Morgan. That doesn't bode well for the avoiding an inflationary event. Pair that notion with the idea that reflation is the only option to stimulate markets right now, and the horizon for a weakened U.S. dollar is coming into focus. Should the 6 trillion fiscal response, a bid to stifle deflationary environment, overshoot, then we're looking at entering the gauntlet of cost-push inflation within the next several years. That is not good. Has there ever been a better stage for crypto to make an audacious entrance into the eyes of mainstream? Probably not, nor will there likely be another opportunity like this. This is where we start to shift the conversation in this article to what we talk about constantly on this channel. People are getting devastated. Their 401ks, they want options. They want options, and they need options. People are losing their jobs and they have to do something. They don't want to stay in a market like this where they're losing their value that they just got back from a decade ago. Open networks and liquidity for the win. For a market structure perspective, the nascent crypto markets have not fared very well in the current crisis either. While Bitcoin is showing signs of decoupling from the S&P 500 trend, it fell more than 50% in a single day, and the crypto market structure effectively broke. However, there are encouraging signs. According to Coinmetrics, money is pouring into stablecoins. Ooh, really? Here's where it gets interesting, which are proven highly liquid alternative to cash positions that many financial institutions and corporations are desperately seeking. The overall stablecoin market cap as a percentage of Bitcoin doubled in only a few days. What this reveals is that stablecoins are more than simply USD-pegged crypto assets for trading more volatile altcoins. Stablecoins serve a unique role for balancing OTC desk remittance operations across borders, and also as a censorship-resistant method for transferring the prize of liquidity crunch cash around the world at low cost and virtually instantly. Okay, let's take a second right there, because what they're telling you is exactly why stablecoins, private stablecoins, are probably going to be banned, right? Because it allows for them to have a censorship-resistant method for transferring the prize of liquidity crunch cash around the world. Yeah, that's not going to last like that. Stablecoins also breed unique privacy advantages, not for long in my mind, for intra-network transactions, which are useful beyond remittances in countries with strict capital controls, extending into the compliance aspect of banks. For example, JP Koenig details how the unique permission pseudonymity of stablecoins enables them to avoid collecting pertinent KYC information on intra-network transactions through a regulatory loophole. Bank accounts, which are not afforded that advantage, induce huge overhead costs for banks to meet compliance laws. If a bank like Wells Fargo could avoid collecting user ID for intra-network transactions, they could sever large sections of the compliance staff and save bundles of money. Whether regulators would accept such a situation for banks is unlikely. I don't think it's unlikely. Which is why they open permissionless framework nature of crypto platforms like the UP protocol is poised to absorb the interest of many mainstream users and businesses, throwing classic examples of government privacy intrusions as the trust in government already erodes due to the pandemic response, and the opportunity for open finance is enormous. Open finance platforms like the UP Alliance and its individual partners provide numerous benefits to small businesses and investors who may be shut out of the fiscal stimulus package. You can count on that. Incidentally, judging by the paltry $300 billion allocated to small businesses, which they're already starting to change how they deliver that, by the way, compared to the $4.25 trillion for corporations, it appears most brick and mortar retailers may need an alternative outside government lending facility. Some platforms like Cred have already secured over $300 million in lending capital. Other platforms more appealing rates and returns than banks without the counterparty risk of bank teetering on insolvency. Listen to this as we go forward here. And they're much more efficient, user-friendly, and flexible than any government program. For example, the national average USD savings rate on banks and deposits less than 100K, which constitutes a bulk of Americans, is only 0.09%. Comparatively, stablecoins like the UPBTC, UPT USD, or the UP Euro on Cred earn or uphold reach as high as 8%. It's unheard of, and when people find out, they flock to it. However, there are international regulations we looked at in the beginning of this that suggest that may be changing. These platforms are transparent, publish audits of their reserves, unlike banks with slash reserve requirements, and offer more stable outlets for businesses to park assets. Assets can be quickly withdrawn, transferred anywhere in the world, and can do so without censorship at a low cost. That's a promising alternative for circumventing the current liquidity crisis. Well, and I think that's why banks and the world and the regulatory bodies and the watchdog from the G20 is recommending that we do some regulation here. So going forward here, and this is really important, listen, those benefits from the UP protocol don't even account for the serious lack of trust in commercial banks right now. Listen to this. Bank of America recently circumscribed cash withdrawals to $3,000, a foreboding sign of insolvency. And the FDIC Gov Twitter handle released an untimely video telling people not to withdraw cash. If a sizable business wanted to do a withdrawal with significant sum of cash right now, early anecdotal evidence is already revealing the banks are making it difficult, delaying transfers for up to weeks. For businesses, tapping open financial solutions now may seem risky if they have no exposure to blockchain or crypto tech. However, the platforms behind open finance like the UP protocol argue that parking your money in a bank is even riskier at this juncture. You don't even need the Fed comment about unlimited money to know that, but it will serve businesses well to have some optionality, should an inflationary event start peaking through the $6 trillion bonanza. Helicopter money may be the calling card of the new financial paradigm we're living in, but crypto was developed for this very moment. What a great article. What a great article. Now the industry just needs to capitalize on the opportunity. That's exactly right. And it looks to me, if you come back to this, that regulators are about to set the way for the large players of the world to once again capitalize on this opportunity. One thing I can tell you is going through this article, these conversations we've had over the last couple of days here, the Financial Stability Board releasing the 10 recommendations to central banks, and including outright prohibition of private stablecoins. What I can tell you is that we watched ICOs get crushed in the crypto space, the initial coin offerings, and they got crushed because they needed to clean that space up. That's it. I am seeing the exact same thing, and they're going to say they're doing it for us. They're doing it to clean this space up for us because there's private companies that can't have the proper reserves to back the asset, which in some cases may be true. But in other cases, in the large macro notion here, I believe they nailed it in this article from NASDAQ, and that simply is this, is that the banks, they see where the back door is, and they see where a lot of money is going, and they don't like it, and they're about to stop it. All right, guys, that's going to do it for me. Hit the like and subscribe. We're one away from 12,000 subscribers. Let's hit that button and make that happen and keep it moving to 15K so we can go ahead and raise the hype bar again. And if you like the content, please share it with somebody you know or on your social media platform. Let's continue to grow this audience. And thank you to each and every one of you for tuning into the channel so much. This is an exciting time that we are going through, even though it is a trying time. But I know one thing, this too shall soon pass. I'm not a financial advisor, but I love this space. I'm built for it. I'll catch you guys on the next one.